demand at 10,930. And you say, well, how can I be so wrong? And how can I have a completely different level? And the answer is, oh, it all depends upon what time frame you're looking at, right? And that's something you've got to remember, that there is the bigger picture narrative. You've got supply and demand on a 5-minute chart, you've got supply and demand on a 1-minute chart, you've got supply and demand potentially even as if you like to take it down into a 1 second and a 5-second chart. Now, why would you change the time frame of reference shorter? Why would you ever change your time frame of reference shorter? It doesn't matter what you change it to, but why would you time it into a shorter chart? Any reasons? If the value changes, for example, and you want to get a little bit more aggressive, right? Would you imagine that if I said to you getting more aggressive means lower time frames, would that be reasonable? Would that be a reasonable statement to make? So obviously, if you start seeing value changing and you want to get more aggressive, then of course, then you want to maybe get into a lower time frame because you don't want to give away $1,000 of potential reversal opportunities, right? That's also true when you start coming into key reference levels, isn't it? When you start coming into key reference levels, you start getting more aggressive. You start maybe reducing your time frame of reference to try and figure out if indeed you had an opportunity to work short selling into that key reference level. So obviously when you come into key references and you start asking the question, you can obviously start trying to find the answer. So here's a great example. We talked about that DAX, the NASDAQ long trade. And we talked about when we left you at the NASDAQ long trade, you can see obviously we were in this very strong buy side, and then it started to really slow down into this key level here. Yeah. So we've had this key level in the chart since the beginning of the day. We have this big reference in the background, of course, which is the change of behavior. It's the S&P RGL, right? Yes. It's the RGL for the NASDAQ. There it is. Everybody's got the same prices I have. Everybody's got the same prices I have. It's a decision I've got to make now, right? Does everybody agree that the RGL is a decision you want to make? So if it's a decision you want to make, everybody must have this decision on their charts, right? Everybody's got this decision. So when we come up to this decision, I want to try and make a decision. Am I buying this or selling this? Am I doing nothing or am I trading it? How do I make a decision? Just because it's a level? Of course not. All the level tells us to do is to try and decide to make a decision, right? What are the big boys going to do at this price? Well, the only way I know what they're going to do is to ask the question, do I have any value to buy this level north or sell this level south? The challenge I've got with the sell is what? There is no structure, right? For me to get into a sell side structure, realistically, I'd probably have to sell it if it goes below that price. Would you agree with that on a 5-minute chart? So for me to become sell side, assuming I'm making a sell side decision in here, right? For me to really get selling this, it'd probably have to go with 10,800, which means I'm giving away a $2,500, nearly $3,000 move before I can really work sell side. Is that really the honest way you trade? That seems bizarre, doesn't it? Way too much. Way too much. As it turns out, it would still have been successful, but that's a different matter, right? You didn't know that at the time. So when I'm coming into a big decision, which is the RGL, I want to know whether they're going to reject this price or accept this price. Now, the way that we've been talking about, obviously, trading this morning is very much the way we trade any news release, and that is to rely on the bond traders. Why do we rely on the bond traders? Because nearly every big trading decision happens at 1:30 every day, right? So usually the big trading decisions happen before the US cash open, agreed? But it's not before the bond market opens. The bond market opens basically at 20 past 1. So all the bond market desks are already open and trading from 1 o'clock onwards. So the bond trading desks are already in full operation at this stage, right? So we rely on the bond information. We're relying on this cash open information to figure out what these guys are going to be doing at the cash open. So if I look for the bond guys to give me a lead into this, what was their decision? Should I buy this level or start looking at the possibility of selling it? Sell, right? So coming into the cash open decision, I'm now looking at the high probability that this is going to get shorted. The value decision is being made in real time from 1 o'clock. So I'm starting to think short sell. I've got two ways of now thinking about this. 5-minute charts are way too big a time frame for me to look at this as a trade now, right? Come off the 5-minute chart and I start drilling down to the 1-minute chart, because what I'm wanting to try and start establishing is A, if I've got any level 2 selling evidence. B, have I taken out the last demand level? So when I start drilling down into this area, you can see the short sell is clearly starting to become visible through this phase here. Through this phase here, of course, we can see that this was the last demand area here. So we've now established a far more aggressive last demand level here. That is a clean break north, yes? It's not like a rejection of lower prices. It's not one candle buyer, it's 2 candle buyers, 3 candle buyers, 4 candle buyers. That's an acceptance of that higher buy price. It wasn't a candle rejection. So this demand line can exist. This demand line can be my change of behavior to try and think about the buy trade reversal in terms of purely going with structure, sell side structures. I could also think about it as a pro trade. I could also think about it as a Heisman. Where's the Heisman trade entry? Well, the Heisman trade entry is here, isn't it? 10,912. As the price goes higher, we're now trading 928s. We're now trading 934s. We're about $400 or $500 above my Heisman entry. Do you want to sell it with a $400 or $500 sell-off before you get into the trade? Is that really what you want to be doing? It seems again as if we're losing too much money before we even get to sell into this, correct? So how do we answer this question? Well, there's a couple of things. Number one is, where is the guaranteed premium in this trade? And obviously we just go for the measured move and we start coming up with some ideas about where the guaranteed premium price is. And you can see the guaranteed premium was 950 wholesale. Now the thing about the 950 wholesale is you can treat the 50s and the zeros the same way as you can treat an RGL, can't you? You can trade the 950s as a Heisman. If it goes above the 950 and then drops below the 950, you can sell off the 950 and put your stop above the high, right? So you could start working into the 950 as a possible rejection. If it rejects 950 and above, I can sell into that rejection above the 950, agreed? So that's a possible play. The 950 turns out to be exactly the guaranteed premium. So that's another possible play. But again, you're always worried about the fact that you are in a bullish structure. So the one thing you're not wanting to do is give away too much money. You do not want to give away too much money. And if you don't want to give away too much money, what are the other choices? Well, it's tough. You would have to go down another time frame, wouldn't you? It's the curve. Yeah, everything we've looked at so far today has just been curve narrative because it's a big data day today, so it's a big curve day today. So we go down the time frames. We're going down into, say, the 15-second chart. And if we go down to the 15-second chart, what do we start seeing? We start seeing a few more aggressive level 2 rejections. You see it? we start seeing a few more aggressive level 2 rejections. So there's one right there. That's an interesting price. And on this occasion, as a level 2 rejection, as I said, we don't want to give away too much money because we are at the top edge. We should really try and give away no money at all. But obviously, if we're looking at this, the break of that level accomplishes something else that's quite interesting, does it not? Well, imagine I changed the question. Where would the demand line be on this 15-second chart? Where was the last demand line? Would you not agree with me that this was an acceptance above this break of structure here? So really the demand came from that trade there, didn't it? So a break of this structure is almost changing the narrative. Is almost changing the narrative into a sell-side structure on a 15-second chart, right? So you're actually starting to accomplish both opportunities at the same time. You're getting a break of structure and you're getting a change in the supply-demand dynamic, aren't you? You're still getting a pretty poor price, but it's not a bad price anymore. You're not like selling $2,000 below the high of the day. You're literally now only selling, you know, off the top edge. I mean, you're still giving away a lot of money, but you're giving away a lot less money than you would have previously. Now, can you keep going down and down and down into lower time frames? Of course you can. If that's what floating your boat, of course you can. But you've also got to remember that there are some frightener candles that you can also trade. You can almost guarantee that this volume here, which is obviously the cash open candle, is also incredibly critical because it is the cash open candle. The cash open candle in its own right has a buy side RGL, sell side RGL at the cash open, right? So as soon as the price rejects the move higher on the cash open, is that not the first rejection sell? Does that first rejection sell not line up perfectly with the RGL and with this change in value divergence? Well, the cash open is an RGL, isn't it? No, nobody's interested in this class. All right, so we'll move on to something else. Let's take a look at oil. Let's take a look at how the oil trades develop, see if anybody has any interest in oil. Okay, so oil. It was buy-side RGL last night, macro buys. We started to have a little bit of a top edge divergence as we moved into the measured moves. Background, you can see what it is. It's obviously previous day high. That's pretty straightforward. And obviously pretty much in line with that previous day high, you can see that it was a great opportunity to sell some oil. We then got what is called a top right-hand hold. Top right-hand hold, buy-side opportunity, structure buys, because obviously the sale's not been successful. We haven't taken the market offered, have we? Because we haven't taken the market offered, it became very easy to become a buyer of these level 2s. Spring trade buy there, and a spring trade buy there, in line with the fact that the dollar started to catch yet another move, or the supply-demand line. In this case, this is a supply-demand line on a moving average, because obviously what we were talking about this morning in classroom was if you don't want to use the spikes of supply-demand, if you don't like using the reg lines because the historical narrative isn't there for you to check, then use the moving average. What's the moving average telling you to do on the calendar spreads? Buy it. The moving average is showing demand, isn't it? So with the moving average showing demand, and then the dollar starting to sell, do you see the dollar starting to sell from that point onwards? In my mind, there's no question about what we should do here. We should start buying back into our oil dips. And obviously we got a level 2 there, we got a level 2 there, and it gave us a very easy excuse to buy into oil. And from that easy excuse to buy into oil, we obviously absolutely annihilated the upside. And again, as we calculate out the supply-demand, not the support resistance, the supply-demand, you'll see obviously this becomes a new demand level here. And obviously as you start working your way through these levels, you take out this high, you take out this high, you then start seeing a rejection of this previous high up here. You start seeing that rejection, which means your trade would be a spring, yes. So there's your spring trade there. There would be your Heisman spring trade right there. The decision is, do you still want it? Well, at that stage, actually, it was still okay because, I mean, the value's kind of lost on the dollar a little bit, but the macro is still very bullish. The macro demand is still very bullish. I don't see any reason why you wouldn't want it. It is what it is. It's a structural, systematic buy trade on oil. So with the systems trade still bullish, market goes again, and you say to yourself, well, that's gone and accepted, easily accepted higher. So obviously your demand line is quite clearly now visible. It's right in there, correct? So that's your new demand line. That acceptance higher, there's your new demand line. Now, we're not getting any acceptance higher anymore. It seems to have ran aground into those higher prints. And that's okay. And that changed in the overnight session. You can see that change in the overnight session here, because we were very bearish in the actual close, very bearish. We'd been selling off the 89s earlier, but we were very bearish into the close, and then about 2 hours later, we suddenly became very bullish. Not because the price started to go up, but because the dollar started to sell and because demand showed up on the short-term curve. And since then, we've been inclined to be trading the macro sells. Macro sells never worked. They didn't work. It doesn't mean we didn't trade them. We did trade them. I sold here and here, and they never worked. I mean, we scratched. We made some money, but they didn't work. And all we had to then do was start to buy back into this as a storyline, and my goodness, what a storyline. $2,500 of extra buy-side profits. So $2,000 on the way up, tuppence halfpenny on the sells, $2,500 on the next phase, $5,000 per contract. Trading the RGL basically. $5,000 per contract. Just trading the RGL. It's kind of crazy, isn't it? Crazy, crazy, crazy. Crazy good though. Crazy good. We like crazy good.